Our next guest says inflation is his #1 concern this year. Wall Street forecaster Jim Bianco is president of Bianco Research. Jim, great to see you. So it's going to be a problem, but in the back half of the year. So what does the Fed do, if anything? Let it go?
Yeah, it's going to be in the back half of the year because I agree with a lot of the comments before that inflation is percolating, but we got the built-in excuse that the economists call the base effect because we're going to drop off the big fall in prices in April and in May. So everybody's going to look past it. But once they get sticky in the back half of the year, I think that's going to be a problem. What's the Fed do? The Fed is going to do what they did the last 2 cycles. They're going to give a bunch of wonky speeches that says, we're going to let it run hotter, 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 just like Guy said. And then the market's going to throw a fit, and then they're going to be forced to respond. That's what happened in 2018 when they tried to taper too much. Remember, it was automatic pilot, watching paint dry. Market threw a fit. Powell jettisoned that within 10 days. A year ago, they said, we're going to stay at 1.5 forever. The market tanked on pandemic talk. And within 10 days, it cut 50 basis points. That's what will happen this time. Rates will keep going up, 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 and then we'll get to a point where the market throws a fit because they're so worried about inflation, and the Fed will be forced to respond no matter what they say. This is how it seems to be working lately.
Okay, so that means that you believe that inflation will, in fact, go hotter than expected because the Fed will be painted into a corner, into not acting. Am I understanding that right?
Yeah, you're absolutely. The Fed is not going to act.
Yeah.
We're going to look past it right now and say it's all good, it's reflation, and it's going to keep going and going. And then in the second half of the year, I think it'll probably be a problem. So it's not an immediate problem for the markets. I don't think that rising rates, this week, next week, into the summer is going to necessarily be a problem for the market. They'll find a way to look past it. But as we continue on, and that base effect that everybody's looking for doesn't go away, and that's what I think happens, then I think it becomes a problem after that.
Hey, Jim, so what about the credit side of this story? Because junk bonds and junk issuance and the concerns we had about essentially a triple B minus tranche 2 years ago taking the world into a credit crisis is now only more of a bubble. I mean, is this part of the same sequence of events that just doesn't really have to be an issue until we get into the fourth quarter? Or is this something that actually could be a risk and there could be some type of a trigger before then?
Back in the spring last year, the word that everybody used was co-invest with the Fed. The Fed had backstopped the high yield market. They were buying high yield bonds or buying high yield ETFs. You can't go wrong buying what the Fed's buying. Now they stopped doing it, but everybody expects that backstop is still there. So as long as you don't have inflation, the corporate market is going to keep running because everybody thinks that they've got a protection on the downside. It's only when you get inflation that kind of forces the Fed's hand to not be aggressive in throwing money at these markets that there will be a rethink. So yeah, high yield is under 4% right now. Double B high yield is approaching the low 3s at this point. It's incredible, these yields. We used to call it high yield, and we have to find a new name for it right now. But this will continue because of that perceived Fed backstop.
Jim, just to follow on that thought, a year ago we were talking about fallen angels, and this year we might be looking at the fastest upgrades from junk status to investment grade status that we've seen in credit history. And I'm wondering what you think the impact of that is, because the flip side to a heating up economy is that companies are in better shape, their business is theoretically better, and they could actually see upgrades, and that could change how investors view junk. That could change how investors view investment grade.
Yeah, you're right that we are seeing that because these companies have been given a lifeline, that they're being able to issue debt, and they've been able to get enough cash to kind of get over the other side of the pandemic. But don't forget, on the other side, we've got a lot of zombie companies that are still alive that shouldn't be alive right now, that are kind of hanging on as well, too. So we've got a lot of companies that are in the pipeline that when we get a turn in the credit cycle, there can be problems with these zombie companies and these other companies that have issued money. I'm thinking like the theme parks that have issued money and are basically burning cash waiting for them to open the theme parks. They could run into trouble on the other side if the credit cycle turns before the reopening happens.
Okay. Jim, great to see you. Thanks for your thoughts.
Shepard Smith here. Thanks for watching CNBC on YouTube.